Imagine you've been driving down a road, confident that you're headed toward the right destination. The weather is clear, the road is smooth, and you're moving at a steady pace. But then, suddenly, you find yourself at a dead end. The road is blocked. No matter how much you push the gas pedal, there's no further progress. You're stuck. You can't move forward, and you certainly can't reverse. This is the reality of what we're facing today in the financial world, and it's a reality that many investors are beginning to confront with a mixture of caution and clarity. The liquidity trap is here. It's an environment where traditional monetary policy, something that has driven financial markets for decades, has lost its power. The fundamental laws of supply and demand seem to be breaking down, and for the first time in modern economic history, the tools we once relied on to stimulate growth no longer work as expected. Central banks have flooded the system with money. Interest rates are near zero or even negative, and yet the economy doesn't respond the way it used to. Now, this situation isn't an isolated event. It's the culmination of decades of debt accumulation, economic intervention, and over-leveraging. What we are witnessing now is the consequence of the system reaching its limits. The very mechanisms that were meant to save us have actually created a trap, a liquidity trap, where even the best attempts to encourage investment and spending are met with stagnation. In the face of significant financial turbulence, one of the first things that must be understood is the transformation of the game itself. The markets we've known, the rules we've followed, and the assumptions that guided us through cycles of boom and bust have fundamentally shifted. What we are seeing today isn't just another downturn or a temporary market correction. This is the result of a deeper, more systemic change. The environment we find ourselves in now is fundamentally different from anything we've encountered before. The traditional tools of central banks, the reliance on interest rates to stimulate growth, and the effectiveness of government interventions have all reached their limits. This transformation forces us to rethink everything we thought we knew about investment, risk, and reward. The first truth we must confront is that the game is no longer about simply following the old patterns. We can no longer look at interest rates, government actions, or market behavior and assume that past trends will continue to serve as reliable indicators for the future. What worked in the past, under different conditions, might not work now. The reality is that we are operating in a world that is increasingly difficult to predict. When the mechanisms that once governed the flow of money and economic activity break down, we must become more adaptable and flexible in our thinking. The financial system is not static, and neither is the landscape in which investors operate. The ability to adapt is not just a survival skill, it is the skill that separates those who thrive from those who falter. In this new environment, adaptability requires a shift in mindset. Investors must now consider more than just the immediate data. They must look beyond the traditional markers of financial health, such as GDP growth, corporate earnings, or the unemployment rate, and assess the structural conditions beneath the surface. It's about understanding the underlying dynamics that influence the flow of money through the economy and how those dynamics are shifting. For instance, when central banks push interest rates to the floor, expecting to stimulate spending and investment, and that expectation doesn't come to fruition, it becomes clear that the market forces are more complex than we've been led to believe. In the past, we could rely on the assumption that lower interest rates would lead to higher investment, which would then stimulate growth. But what happens when the market no longer responds to these stimuli? When investors, businesses, and consumers are all aware that the tools available to central banks have lost much of their effectiveness, they start acting differently. We see businesses holding on to cash rather than expanding, investors growing wary of long-term commitments, and consumers becoming more cautious about their spending. This isn't a short-term blip. This is the new reality. Adapting to this new reality requires recognizing that the familiar patterns are breaking down and a new framework is necessary. It's no longer enough to simply follow trends and hope they continue. Instead, it becomes critical to recognize when the system itself is signaling a shift, when the mechanisms of monetary policy stop having the desired effect, and when the economy shows signs of stagnation despite massive liquidity injections. We must ask the harder questions. What is really happening under the surface? Why is the market behaving this way? What are the root causes of this breakdown? The key to adapting to this new financial reality is to let go of the assumption that the system is inherently self-correcting or that the past will always provide a reliable guide for the future. The future doesn't look like the past, and pretending it does is a recipe for failure. So, how do we adjust our mindset? It starts with focusing on understanding the new dynamics in play, how financial decisions are made when traditional mechanisms fail, how markets react when central banks no longer have the same level of influence, and how to anticipate the moves of other market participants who are themselves learning to operate in an unfamiliar landscape. This shift requires developing a more sophisticated understanding of risk. In a world where monetary policies are increasingly ineffective, the risk of staying too tied to old models of thinking becomes increasingly apparent. We can no longer assume that high levels of debt or low interest rates will automatically translate into a prosperous future. The risk of overstaying in a market that no longer functions as expected is real. That's why adaptability is key, not only in how we respond to immediate market shifts, but also in how we reframe our entire approach to investing and risk management. The game may have changed, but the essence of what makes an investor successful hasn't. In fact, in times of uncertainty, those who have cultivated a deep understanding of the underlying forces driving market behavior are the ones who can take advantage of opportunities, even when others are panicking. It's about having the ability to see beyond the noise and distractions and to focus on what truly matters, understanding the forces that shape the financial world, having the courage to act on what you see, and knowing when it's time to step back and reassess. At the core of this shift is a deeper understanding of cycles. Financial markets are cyclical, and cycles of boom and bust are inevitable. But what happens when the cycle breaks down, when the systems we rely on don't function in the same way they once did? This is where the ability to adapt becomes even more critical. Savvy investors recognize that no market condition is permanent, and that today's challenges are not the end of the road. They're an opportunity to prepare for what's next. If you're waiting for the old systems to kick back in, you're missing the point. The cycle has already changed, and with it, the opportunity to thrive in a new financial environment. The only question that remains is whether you'll be able to adapt in time to capitalize on it. When we talk about liquidity in today's financial markets, we're addressing more than just the basic concept of cash or assets that can quickly be converted into cash. We're talking about the very pulse of the financial system, how money flows, where it flows, and what happens when that flow gets disrupted. In normal times, liquidity is the lifeblood of markets. It enables investors to make quick decisions, to buy and sell assets, and to ensure that capital can be efficiently allocated across the economy. But in the current environment, liquidity is no longer operating the way it used to. In fact, we're witnessing the emergence of a new reality, a liquidity trap. A liquidity trap is a situation in which, despite central banks' best efforts to inject liquidity into the system, often through low interest rates or large-scale asset purchases, the economy simply doesn't respond in the way we expect. More money is available, but it doesn't circulate the way it should. The standard mechanism of monetary policy, where lower interest rates encourage borrowing, investment, and spending, breaks down. In this new world, investors, businesses, and consumers aren't as willing to take risks with their capital. Instead, they hold on to cash, waiting for conditions to improve or for signs that the economic system will respond in a way that justifies their investments. In traditional economic theory, liquidity is a means to stimulate growth. When the central bank lowers interest rates or increases the money supply, it encourages borrowing and spending. Investors are expected to use the extra capital to take on riskier projects, businesses are supposed to invest in expansion, and consumers are encouraged to spend more, all of which contributes to economic growth. But when the economy is in a liquidity trap, that doesn't happen. The money isn't flowing into the real economy the way it should. Instead, it remains trapped in financial markets or on balance sheets, creating a disconnect between financial conditions and economic performance. One of the most important insights about a liquidity trap is that it's not just a temporary phenomenon. It is often a result of deeper structural issues within the economy that make it harder for liquidity to have its desired effects. These issues may include high levels of debt, where individuals and businesses are more focused on reducing their liabilities than on expanding or investing. It could be a result of widespread pessimism about future economic prospects, where even low interest rates fail to inspire confidence. Or it could be the result of a fundamental breakdown in the transmission mechanisms of monetary policy, where central banks' actions no longer have the expected impact on economic behavior. In a liquidity trap, holding cash becomes a rational choice, even when there are abundant funds in the system. Investors are unwilling to take on risk because the returns no longer seem worth the risk. Businesses are reluctant to invest because they can't foresee a clear path to growth or profitability. Consumers, burdened with debt or unsure about their economic future, hold back on spending. This vicious cycle creates a situation where the central bank's traditional tools no longer work as intended. The injection of capital into the system may provide temporary relief, but it does not generate the kind of economic activity that would drive long-term growth. In such a scenario, liquidity itself takes on a different meaning. It's not just about how much money is available, it's about how money is being used. In the past, liquidity was a trigger for action. It allowed businesses to expand, investors to take on new opportunities, and consumers to make purchases. But in a liquidity trap, money remains inert. It's not being used to fuel the kind of productive activity that drives growth. This creates a fundamental challenge for policymakers and investors alike. How do you stimulate growth when the usual tools don't work? How do you encourage the flow of money when people are simply unwilling to spend or invest? To navigate this new reality, investors must think differently about what liquidity means and how it can be leveraged. It's not just about having access to capital, it's about understanding where that capital is being allocated and whether it is actually serving its intended purpose. The first step in this process is recognizing that liquidity isn't always a sign of economic health. In fact, too much liquidity can sometimes signal the opposite: a system that is failing to allocate capital effectively. When there's an abundance of money in the system, but a lack of investment opportunities, it's a sign that something is wrong. The financial markets are not functioning the way they're supposed to. This is where the importance of risk management comes into play. In times of liquidity traps, the risk of holding onto traditional assets, such as stocks, bonds, or real estate, becomes more pronounced. If money isn't flowing into the economy as it should, the value of these assets can become increasingly uncertain. Even if the liquidity is there, the underlying economic fundamentals may not support the value of these assets. That's why it's so crucial for investors to reframe their approach to risk. Instead of relying on traditional models of asset allocation, they must think critically about the underlying dynamics of the market. In a liquidity trap, the traditional assumption that low interest rates will stimulate demand for riskier assets no longer holds true. This is why savvy investors are looking at alternative forms of liquidity, investments that are less tied to traditional financial markets and more connected to real economic activity. They are seeking out assets that are less vulnerable to the distortions caused by central bank policies and more likely to benefit from long-term trends in the economy, such as innovation, demographic shifts, or structural changes in industries. The key takeaway here is that liquidity in a liquidity trap is a double-edged sword. On the one hand, there's plenty of capital available, but on the other hand, that capital isn't flowing into productive investments in the way it should. The true challenge for investors is not simply to find liquidity, but to understand how to use it effectively in an environment where traditional economic models no longer apply. Those who succeed in this new landscape will be the ones who can adapt to this shift, understanding when liquidity is merely a sign of dysfunction and when it can be harnessed to create long-term value. The ability to recognize the difference between these two scenarios will be what separates the successful investors from those who are stuck in the old paradigms, waiting for the old systems to return. In the world of investing, one of the most underappreciated and often underestimated forces is the role of sentiment and psychology. Financial markets are not just a collection of numbers and charts. They are made up of people, investors, business leaders, consumers, whose decisions are driven as much by emotions, perceptions, and fears as by rational calculations. This becomes especially clear when we find ourselves in a challenging economic environment, such as the one we're experiencing today. When markets are uncertain and financial systems are strained, the emotional undercurrents that drive decision-making become even more influential. Understanding this shift in investor psychology is crucial for anyone looking to navigate the current financial landscape. One of the key psychological phenomena we are witnessing right now is the shift from FOMO, or the fear of missing out, to FOL, or the fear of losing out. In a bull market, the sentiment is driven by optimism, and people are eager to get in and take advantage of rising prices. Everyone's making money, and there's a collective belief that the good times will keep rolling. This creates a kind of herd mentality where people feel pressured to invest in order to not miss the opportunity. This type of behavior drives up asset prices beyond what fundamental valuations might suggest, and it can lead to bubbles that eventually burst when reality sets in. However, when the market shifts into a more cautious, uncertain, or even declining state, the psychology changes dramatically. The fear of losing money becomes the dominant emotion, replacing the optimism that once fueled buying behavior. In these times, the fear of losing what one has becomes more intense than the fear of missing out on potential gains. Investors shift from thinking about how much they can gain to how much they could lose. This shift is powerful because it often leads to irrational decision-making. People begin to pull back, holding onto their assets in fear of further losses, even when it may not be the most rational choice. The irony is that when fear takes hold, investors often make moves that exacerbate the very risks they are trying to avoid. They sell at the wrong time, retreating into cash or low-yield assets, where their capital is preserved but isn't working for them. This action may feel like the safest option in the moment, but in the long term, it can prove to be a costly mistake. Fear-driven selling often happens in a panic, and it can push markets down further, making the recovery more difficult. Moreover, by exiting markets too soon, investors might miss out on the rebound that inevitably comes when the cycle turns or when the panic subsides. This cycle of fear and greed, what some call the emotional market cycle, is not a new phenomenon. It has existed for as long as financial markets have existed, and it plays a crucial role in shaping how markets move over time. The challenge is that, while it's easy to look back and see these emotional cycles in hindsight, it's incredibly difficult to recognize them in real time. In the moment, emotions can cloud judgment. The key to success in this environment is understanding how human psychology works in these situations and then taking a step back to observe the larger picture. When markets are volatile, the fear of losing is often heightened by a sense of uncertainty. People don't just fear losing money, they fear the unknown. In uncertain times, it's natural for people to become risk-averse. When the future seems unclear, the inclination is to take less risk and retreat into safer assets. But the problem is that this approach can trap investors in a cycle of missed opportunities. The very assets that appear risky in times of uncertainty are often the ones that recover the fastest when conditions improve. Fear leads investors to avoid these opportunities, locking them into positions that offer low returns and leaving them unprepared for the eventual shift back to more favorable conditions. The behavior of investors in a liquidity trap, for example, is often driven by these psychological forces. In such environments, even when there is a glut of liquidity in the system, people become hesitant to spend or invest. The risk appetite shrinks, and the focus shifts toward preserving capital rather than generating returns. This is where understanding the psychology of fear and loss is essential. Investors who can resist the emotional pull of panic and instead stick to long-term strategies are the ones who tend to emerge from these periods in a stronger position. They understand that the cycle of fear and greed is inevitable and that maintaining a disciplined approach, focused on fundamentals rather than short-term market movements, is key to success. The reality is that psychological factors such as fear and uncertainty often cause investors to behave counterproductively. During periods of market distress, they tend to lock in losses, not because the fundamentals have changed, but because their emotions have taken over. This is when the danger lies, not in the market itself, but in the psychological reaction to the market. Investors become reactive instead of proactive. They make decisions based on their emotions rather than their rational understanding of the market's long-term potential. A critical aspect of navigating this environment successfully is to recognize when sentiment is becoming overly pessimistic or overly optimistic. Being able to discern these emotional swings gives you a powerful edge, as they often precede market turning points. When markets are in panic mode, and the majority of people are fearful, it's often the time when some of the greatest opportunities are created. The key is not to let fear dictate your actions. The investors who thrive in these conditions are the ones who remain calm, who maintain a long-term perspective, and who understand that emotions like fear and greed are temporary. The great challenge of investing is not just understanding the numbers, the charts, or the trends, but understanding human behavior. Markets are driven by people, and people are driven by their emotions. Fear, greed, and uncertainty shape market dynamics in ways that are sometimes more powerful than any economic indicator. Understanding this and having the discipline to avoid being swept up in the emotional cycles is critical for anyone who wants to succeed in the long term. It's not about avoiding fear altogether. It's about learning how to manage it, how to recognize when it is influencing your decisions, and how to make rational choices in the face of uncertainty. The notion of preparation in the context of financial markets cannot be overstated, especially in the face of uncertainty and economic challenges. It's easy to get caught up in the idea that the right investment decision is purely about timing or seizing opportunities as they arise. However, the most successful investors, the ones who consistently outperform over the long term, are those who understand that success in investing is not about predicting the future with precision. It's about preparing for all eventualities. Preparation is not just about having the right strategy in place when things go well. It's about having the foresight to anticipate what might go wrong and ensuring that your position is strong enough to withstand unforeseen changes in the market environment. The process of preparation starts long before the market starts showing signs of distress. It's not something that can be built overnight or achieved through quick, reactive decisions. Instead, it is a mindset and a system that must be cultivated over time. Preparation involves laying the groundwork when things are stable, when the markets seem predictable, and when the conditions might feel ideal. This is often the time when complacency can creep in, when investors feel that they've made it, that the right strategy is working, and that they can sit back and relax. But in reality, this is when the most critical work is being done. Investors who thrive in times of economic uncertainty are not the ones who sit on their hands waiting for the storm to pass. They are the ones who are constantly assessing, constantly questioning, and constantly refining their approach. They understand that the world of finance is constantly changing, and they are always preparing for a scenario where conditions may not go according to plan. While many investors focus solely on returns and how they can maximize profits in the good times, successful investors understand the value of downside protection. They know that managing risk is just as important, if not more so, than managing returns. A critical aspect of preparation is diversification. This doesn't just mean spreading your investments across a range of asset classes, sectors, or geographies. Diversification is a deeper concept. It's about ensuring that your portfolio is structured in a way that can weather various kinds of storms. When everything is going well, diversification may seem like an unnecessary precaution. After all, the market is rising, and the focus is on making money, not on protecting it. However, the true value of diversification becomes apparent when the unexpected happens, when the markets shift and the economic environment changes dramatically. Many investors, in their pursuit of higher returns, fall into the trap of concentration. They place a large portion of their bets on what seem like sure things, believing that these opportunities will continue to grow. However, this approach leaves them vulnerable when things change. The markets do not remain static, and there are always forces at work that we cannot predict. A well-diversified portfolio spreads risk across a range of assets that react differently to the same economic conditions. For example, when equities are struggling, bonds or alternative investments may be thriving. When the global economy slows, domestic assets may perform better than international ones. Diversification allows an investor to be prepared for a range of scenarios, increasing the likelihood that their portfolio will perform well under different conditions. But diversification alone isn't enough. Preparation also involves having a deep understanding of the forces that shape the market. It's not enough to simply react to market movements as they happen. The most successful investors are those who can anticipate market cycles, who understand the broader economic environment, and who recognize the early signs of potential shifts in the market landscape. They are constantly gathering information, assessing risks, and rethinking their strategies based on what they're seeing in the world around them. This kind of preparation requires intellectual curiosity and the willingness to challenge conventional wisdom. It's easy to get comfortable with the information that's readily available or with the narratives that are widely accepted. But the truth is that markets are complex systems, and no single piece of information can give you the complete picture. Successful investors are those who can filter through the noise, look beyond the headlines, and ask deeper questions about what's really going on. They understand that the most important information isn't always obvious, and that the answers to some of the most critical questions lie in the details that others might overlook. Moreover, preparation involves recognizing the value of mistakes and learning from them. No one is immune from making errors in judgment, but the key is to learn from those mistakes and to apply those lessons moving forward. This is where experience becomes invaluable. The ability to recognize when a mistake is being made, to assess why it happened, and to adjust accordingly is a hallmark of successful investors. In fact, some of the greatest opportunities for growth come from looking back at what went wrong in the past and using that knowledge to make better decisions in the future. Another crucial aspect of preparation is building a robust risk management strategy. It's easy to focus on how much money you could make if things go well. It's much harder to prepare for the possibility that things might not go as expected. Risk management is not about eliminating risk entirely. Such a thing is impossible. Rather, it's about understanding the different types of risks you're exposed to and knowing how to mitigate them. Whether it's through hedging strategies, maintaining cash reserves, or having contingency plans in place, successful investors are always prepared for the worst-case scenario. The key to risk management is also about maintaining flexibility. When things go wrong, the worst thing you can do is to be rigid in your approach. Markets are constantly evolving, and the ability to adjust your strategy to reflect changing conditions is essential for long-term success. This means having a system in place that allows you to pivot when necessary, to move quickly when new opportunities arise, and to let go of strategies that are no longer working. Finally, preparation means having the discipline to stick to your strategy when the going gets tough. It's easy to make decisions in calm, rational moments. The true test comes when things are uncertain, when the market is volatile, and when fear starts to creep in. In these moments, it's critical to rely on the preparation you've done in advance. This means having a clear plan, understanding the risks, and being willing to stay the course, even when it feels uncomfortable. Emotional decisions made in moments of panic often lead to regret. Successful investors know this and are disciplined enough to stick to their principles, even when the market is testing their resolve. In times of uncertainty, those who are well prepared are the ones who emerge with the greatest advantages. It's not about having the perfect strategy or the best prediction of the future. It's about ensuring that you are ready for whatever the future holds. By preparing for all eventualities, diversifying, managing risk, learning from mistakes, and staying disciplined, you are positioning yourself not just to survive, but to thrive in the face of adversity. In times of economic uncertainty, the key to success lies not in predicting the future with precision, but in being fully prepared for any scenario. The challenges of today's financial landscape, marked by liquidity traps, shifting investor psychology, and systemic shifts, demand that we move beyond traditional thinking and embrace adaptability. Investors must understand that the rules of the game are constantly evolving, and success comes not from following the crowd, but from anticipating change, diversifying risk, and making decisions rooted in long-term principles rather than short-term reactions. The road ahead may seem unpredictable, but those who understand the power of preparation will be the ones who thrive. It's not about avoiding risks or looking for quick wins, but about positioning yourself to weather the storms and seize opportunities when they arise. The most successful investors are those who embrace the uncertainty, maintain a disciplined approach, and focus on the fundamentals, understanding that both the good times and the bad are part of a larger cycle. By staying adaptable, being aware of psychological dynamics, and preparing for all possible outcomes, you can navigate the shifting tides of today's markets and come out ahead in the long run.